Hello, I wanted to send you a video about Chapter 4, which we had intended to go over Thursday night, but it wraps up the wrapping up of the accounting cycle. So far you've learned about posting, about using the general journal, the ledgers. You've learned about making corrections and adjustments till you get to what's known as a final trial balance, and hopefully everything balances. Now the final stage is creating the reports that you need to understand the nature of your business, how you've been doing. And the three major reports are, there's four, but the three that they want to go over here is income statement or profit and loss, the balance sheet, and the statement of owner's equity. So there's an example of each of those on page 166. Now, the balance sheet represents the accounting formula, the assets equals liabilities plus equity. Therefore, it usually concerns itself only with the categories of ledgers that start with 100 for assets, 200 for ledgers, and 300 for equity. The profit and loss statement is concerned with the revenues, which is 400 category or 4,000, whatever that is, the four categories, and expenses, which is the five categories. Extraordinary items might come in later, but generally that is the cleanest way to understand how you're going to generate this report, or these reports. The owner's equity is really going to be where you started last quarter, what you're retaining, where you've distributed, and what the final or new equity balance is. And that's fairly straightforward. So on putting in the expenses, you're going to create a profit and loss statement, which is fairly well structured. The top part will have the total revenues of all parts, and it may be one, two, or three. You might have interest revenue, you might have whatever, but you have the revenue on top. That's followed by a section for the general manufacturing expenses, which is the cost of running the factory, the labor, what it costs you to put the bicycle together. What it doesn't cover is the front end of the business, the accounting clerk, the reception, the owner, things that are not directly hands-on into the making of the product or the service. So those are called general expenses, and after you subtract the general expenses from the total revenue, you have gross margin. And gross margin is basically how much money you've applied on a percentage basis against revenue to create your manufacture your product. In the next section, you'll have what are known as general selling and administrative expenses. Now, these are types of things that cover the front office. They cover the accountant, the accounts receivable clerk, the accounts payable clerk, the owner, supplies, things that are not necessarily involved in running the manufacturing of the office. So it can also include prepaid insurance or insurance, and subscriptions, entertainment expenses, travel. There'll be a list that you can see that is generally considered to be SG&A. Now, when you subtract SG&A from gross margin, and so you come up with the net margin, which is what it costs you pretty much to produce the business. EBIT, earnings, EBIT, earnings before interest, taxes, depreciation, and amortization. Now, assuming that corrections have been made, EBIT should be fairly clear. And then you go in and make the adjustments for the depreciation or amortization or depletion allowances, and you'll come up with, and then you have the amount of taxes that you're going to withhold that are due, and any interest payments that you're going to be sending out to the bank, or did send to the bank. That's called EBITDA, earnings before interest, taxes, depreciation, and amortization. That is your net profit. That is the final, that's the money that you've kept. That now goes over to the statement of owner's equity, and that is subtracted depending upon if it's a positive or a negative, along with any additions or withdrawals to equity. and that comes out as the owner's equity statement. Now, page 172 and 173 are talking about some of the ledger items and net solutions, which is their example. And then you come up with what's known as the pre-closing trial balance. And if everything works, then you simply close out your accounts by setting all of the revenue and accounting data, revenue and expense data to become zero, and post the retained earnings over to the owner's equity portion as an equity, as a retained earnings or operational income. Once the trial balance is done, you can have, which is on page 180, what they call preparing an operational end of period statement. And if you follow that on page 180, 181, you'll see the spreadsheets that they're suggesting you use on Excel. When you prepare the adjusted balance, you prepare the final statements. And basically, some people use this in a 6-column spreadsheet. Some people just to push a button on QuickBooks and it comes out. But basically, you're going to have the final answers or the final balances for accounts 1, 2, and 3, the assets, liabilities, and equity. The first column is going to be the debits of the entire operation. The next column is going to be the credits of the entire operation. Then you're going to have the balance sheet information, which is going to be accounts 1, 100, 1000, whatever those accounts code you've created, and the liabilities and equity. The third, so then you have the debits in one column and the credits in the next. In the fourth column, you're going to have revenue and expenses, debits and credits. And those will be, those last two columns, or the last two sections of columns, are going to be your trial balance values. And now you might notice that the values in the revenue and expenses don't balance. That's because you've got a profit or a loss. That will then be posted later to retained earnings to balance out the accounts. I'm going to take a break for a few minutes and I'll be back with section 2.